Hello, and welcome to this week's edition of Retire Well, the show that's designed to help you retire well in every aspect of your life. I'm your host, Kristen Oakley, and joining me in the studio is Kevin Bucher. He is the co-founder and a financial advisor at Citizen Advisory Group. Kevin, my friend, it's great to be back with you. Another great week to help the folks that we're serving out in Northwest Ohio and Southeast Michigan.
Yes, it's a great time to be here. It's always great to be with you, Kristen.
Thank you.
And today I'm looking forward to kind of talking through some of the distinctly different phases of your financial life. So we go through many different phases of our finances. We're going to kind of highlight some of the key planning areas through these different phases.
I'm excited to get into this because this is something I think a lot of folks aren't even aware of. Have you ever thought about the fact that there's different phases to your retirement? And as a result, there's different aspects that need to be taken into consideration as part of your overall financial plan. So let's get into these different phases because I think it is really important just to set the context for the shifts and the changes that we go through as we are before retirement, entering retirement, and then throughout the rest of our lives.
Yeah, and I think a lot of times we meet with folks that are maybe a little too hung up on things that have maybe happened in their past that we don't have any more control over. We can't go back and change.
Right. Yeah.
And I think the more we can focus on your future and the more you're focused on your future, the better that future is going to be.
Absolutely.
So here's the different phases we're going to hit on today.
All right.
I have some of the phases broken into two different categories. So the first phase is your working years. And I have that broken into your early working years as well as your later working years as you're getting closer to retirement. And then we're going to talk a little bit about your retirement years, again, broken into the two phases. So one phase being the earlier retirement years, the other being the later retirement years. And I'm using the age of 73 as kind of the transition from early retirement to late retirement.
Okay.
So any idea on why 73?
I do know why you're saying 73. That would have to be with RMDs, right?
Yes.
Required minimum distribution.
So at 73, that's when those required minimum distributions start, and we have to start taking distributions from our investments. So again, we're gonna talk about those retirement years. We're also gonna talk about what we would call the survivor years. So for married couples, when the first of you passes, how does that change your financial plan? And then ultimately, the last phase is your legacy plan when you're no longer here.
Right.
So making sure that things are set up the way you want them to be for your legacy.
Which I always say is one of the most loving things you can do for the folks that you leave behind. It's never a fun thing to think about, but it's such a critical part of your overall financial plan. So Kevin, let's definitely get into this. That's 6 phases, right? I mean, I haven't heard anyone else break it down so well, and so I'm excited to go through each phase with you.
Okay, so let's just go chronologically.
Sounds good.
And let's start with those early working years. So we're talking about folks that are maybe in their 20s or early 30s, just getting started. But that doesn't mean you shouldn't be doing financial planning. And there's some key components there. But the one I really want to focus on is the decision about your retirement savings.
Okay.
So you have choices on what type of accounts you should be putting your retirement savings in. And in today's marketplace, that has expanded a little bit. It's made even better choices maybe for today's workers.
There's more options than there ever have been, right?
Yeah, it's easier for workers today to save tax-free money than what was for workers of the past decades, right? So, but I think that's a fundamental decision that early workers have is, do I want to save money in the traditional IRA or 401k account, or do I want to save money in a tax-free account like a Roth 401k or a Roth IRA account?
Which a lot of companies are now offering these Roth 401ks. That's a relatively new development.
Yeah, so it's really opened up the doors for people to accumulate more tax-free wealth for themselves.
Right.
So I think it's easiest to understand these two different account types by just kind of walking through an example, right? So if we're going to put money into the traditional 401k or IRA account, we actually get a little bit of a benefit tax-wise for doing that.
Right, you get a tax break today for making that
I get to
contribution.
deduct that away from my income for this year.
Right.
Now, there's a consequence to that too, and that is later, when I go to take money out of that retirement account, it's all going to be taxable. Now, comparing that to the Roth options, I don't get that tax deduction up front, but the money accumulates in that account tax-free, and I can withdraw it from that account tax-free later. So again, I think it's easiest to think about this by using an actual example.
Go for it.
All right, so let's say I was a 30-year-old worker. And as a 30-year-old worker, just to keep the math simple, if I was saving $10,000 a year into my retirement account, if I put that into the traditional IRA or 401k rather, I'm going to get a tax deduction on that $10,000. But if I'm not going to access those funds until I'm, say, 70 years old, I've got 40 years of growth on that account. Now, investment returns are certainly not guaranteed, but I think a reasonable assumption would say if I average 7.2%, my money's going to double for me every 10 years. And again, 7% return is certainly not guaranteed, but I think it's a realistic expectation to use for this example. So if my money's going to double for me 4 times, that $10,000 contribution is going to go from 10 to 20 to 40 to 80 to $160,000.
The beauty of compound growth, right?
Compound growth.
Yeah.
When you look at it in that perspective, it's pretty amazing, right? So if I put that $10,000 into the pre-taxed account, yes, I got a tax deduction on the $10,000, but now I have $160,000 that hasn't been taxed yet that's going to be taxed on the way out. Conversely, if I put that $10,000 into the Roth account, well, I didn't get the tax deduction on the 10, but I'm now sitting on $160,000 of tax-free money. So advice that I give to a younger worker, and everyone's situation is different.
Sure.
So everyone's individual
general,
situation, right? But for a younger worker, I think it's reasonable to assume that your income is probably going to be higher later on in your working career. It's more important to get the income tax deduction when your income is higher than when you're a starting out worker.
Yep.
And you don't have the benefit of all those years of compounding growth as an older worker. So what I encourage folks to think about or consider for themselves is put the money into Roth when you're 25, 30, maybe even 35. Forego that tax deduction in order to get that lifetime tax-free growth.
Yes.
But then later on in life, now maybe put the money into those pre-taxed accounts, take the tax deduction because it's not going to double for you as many times.
Yep.
So simple things to really make a huge impact for you over the long haul.
Right.
There's certainly other considerations in these early retirement years. Debt control. You don't want to get yourselves in a bad debt situation. Having proper insurance coverage. Lots of things to consider, but I wanted to focus just on that one area from a tax standpoint today.
And I'm so glad you did, because I think anyone who's older or past that phase is going, this is the stuff that I wish I had known when I first started working, right? Because time is the biggest asset you will ever have, and you want to make the most of it.
Yes, and so it's interesting. So we do a lot of live events, and a lot of times these live events are more tailored to individuals that are getting near retirement or already retired. I still tell this exact same story because I want them to go home and tell this story to their kids and grandkids so that they can have the power of this tax-free growth for them for 40 years, like we talked about in the example.
For sure. Well, I know you have a special offer for our viewers today, and we have so much more to get into with the different phases, but why don't you present what's going to happen when they pick up the phone and call?
Yeah, so calling today, we're going to set up a consultation, and one of the things we're offering at that is a written retirement plan for you that'll kind of show what your retirement income projects to be. With that, it allows us to really do some tax analysis and tax comparisons that'll compare what is your tax liability today compared to what your tax liability looks like in the future at these future dates. So we can run this tax report. It's a complimentary offer for callers from today's show. It takes a snapshot of your current tax liability that we can then use and compare to some future tax years so that we can make informed, wise decisions in regards to your tax strategy moving forward.
So important, and I'm so grateful that you're offering that. Kevin, thank you so much. To our viewers at home, that number to call to get your complimentary tax report is there on the bottom of your screen. Simply dial 866-630-1675. You're also welcome to take out your smartphone. Simply open up that camera app. You can point it and scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and a member of the team from Citizen Advisory Group will reach out to you to schedule your time to come in and get your complimentary tax report that way as well. We have a lot more phases to cover as it relates to your retirement planning right after this.
I have a bachelor's degree in education. I spent the first part of my working years teaching. I left the teaching world and went into a family business endeavor that eventually led me down to the financial services world. And there really is a lot of overlap between the two, taking comprehensive topics and breaking that into common sense, easy to understand framework, whether that was in the classroom or now in a meeting room with clients. There was a transition, but some of the skills from the education world transferred very well over into the financial world. By and large, people are very confused about the financial planning process, and oftentimes they kind of settle for the default outcome of that, of not really having control. One of my favorite parts of the process is putting the solutions together and then presenting that back to the client and seeing maybe some light bulbs going off to understanding things that maybe there wasn't a great understanding of before. Setting goals, working towards those goals, and helping them along this journey to having a more successful financial outcome. I do have an oversight role as well, where I'm overseeing other advisors. We work very well together in a collaboration where we bring different areas of knowledge and expertise to the table to really provide more comprehensive solutions for our clients.
Welcome back to Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, co-founder and financial advisor at Citizen Advisory Group. We are talking today about the different phases of financial planning, phases for your retirement. And we spent a great deal on the first segment talking about those early working years, such valuable information. Let's talk now about the late working years.
Yeah, so we really got to get moving, right?
Yes.
There's so many phases to this to cover. And things do start to evolve and change. What we talked about in that first segment still applies. So we have to think about our saving strategy. What makes sense? Should we be putting money in pre-tax accounts, or we should be putting money in tax-free accounts? So that still applies, but really we need to start really focusing on our retirement income plan for when we're no longer in the workforce.
Right.
So we don't want to wait till we're actually retired to start to build the plan out. We need to start building this written income plan, which pulls together your resources for funding your retirement years. So that starts with Social Security, potentially a pension, and then finally your investments, on packaging all those together to deliver a sustainable income for you for the rest of your life.
Yes.
So we have to start that process well before retirement, because it's probably the number one consideration for when you'll be ready to retire.
For sure.
A lot of times the focus is on how much do I need to have saved?
Right, what's your number, right? That was kind of a hot campaign for a long time. How much money do you need to have saved in order to be able to retire is what you're talking about.
Yeah, and I look at that as that was close to being the right question to ask, but the number is not so much about your assets as it is about your income. As a population, we still aren't that well equipped to live off of the lump sum of money that we've accumulated in our investment portfolios. We live off of our income, so we have to recreate that in retirement.
Right.
And we think of that in two general categories. As far as how do we build out your plan, we need to first solve for the necessities of life, right? So there needs to be different strategies for the money you're going to need to put a roof over your head and food on the table than there is for the vacations, for example. Because we have to have shelter, we have to have food, we have to have the basic necessities. And there's certain options from an income standpoint that maybe aren't as reliable as others.
Right.
And that needs to be very reliable in how it's built, right? So
And it's ongoing. It needs to last you the rest of your life as well.
yes, we're going to need a roof over our heads for the rest of our life.
Right.
So we have to use the right strategies to meet what our needs, projected needs will be, as well as what our wants of life. So we think of it in those two categories of what do you need and what do you want? And then we're going to use different strategies to deliver those two different outcomes.
For sure. Well, and you mentioned that this needs to happen before someone reaches retirement. And of course, the next phase is early retirement. But I'm just curious, how soon do you recommend someone, or how many years out from retirement should someone really be focusing on these things?
Yeah, so the retirement income plan is really something that can be you start building way early. Could be even in your 30s. I kind of mentioned the decision you're making about pre-tax savings versus tax-free savings.
Right.
Well, if I've built a retirement income plan, I can actually run projections for what my future tax liability would look like.
Yes.
And that helps answer that question, should I do pre-tax savings or tax-free savings?
Yep.
So the retirement income plan, ideally, you've already started it when you're in your 30s and 40s, but you really need to start fine tuning it then once you're in your 50s,
For sure.
as it's starting to become real.
Yes, absolutely.
And that's a scary time for a lot of folks. And what I will tell you is if you have a retirement income plan, I've seen it time and time again in our office and the team of advisors we have, that a retirement income plan, people kind of refer to it as the crystal ball for your financial plan, because it does give you a look out into the future and gives you some certainty as far as what your future is going to look like. So retirement income plan, ultra important. And that was a general answer that always you should have a retirement income plan, but you really need to start focusing on it when you're in those 50s.
And gosh, there's so much to talk about. We should do an entire show on that. Maybe we will in the future, right?
I think we actually will.
Yes, awesome.
Yes.
Well, let's keep going with the different phases. So next up is early retirement. So talk to me a little bit about what folks need to be taking into consideration during those years.
Yes. And I'm kicking myself because I'm not sure I left myself enough time.
No,
because what I'll tell you is, the pre-retirement years are super important.
Yes.
But we've also found that the early retirement years are prime planning opportunities to start to really take control over some of the key planning areas. In particular, one would be taxes. This is not always the case. Everyone's situation is very different. And I know those of you at home, you have a unique situation. And I don't like talking about general rule of thumb because you're not a general rule of thumb. But generally speaking, we have found that these early retirement years are the prime windows of tax planning, where we can start to try to de-tax those pre-taxed accounts in the most efficient way possible.
And how do you typically go about doing that?
So we're kind of talking about Roth conversions. So Roth conversions are the exercise of taking your pre-tax dollar, paying the tax on it today, and moving it into the tax-free. Ideally, and this is in our notes of things I want to talk about. By the time you get to retirement, I think it's important that you have diversification. And people are familiar with that concept, and we hear it all the time, and it's usually about your investment portfolio, but it's very true for your taxes as well. So instead of having all your money in pre-taxed, and which is where we find the bulk of it today.
Right. Most people have saved most of their money in those pre-tax tax
in the 401k.
Accounts. Yep.
Yes. And we see that time and time again, but it's not too late.
Right.
So we can start to create some of that tax diversification. And I have found that the early retirement years are a prime window to do that, utilizing strategic Roth conversions. So let me kind of walk through a client example real quick to kind of highlight this.
Perfect.
So George and Ann, great clients that we work with, and they're retired. They were retiring in their late 60s. They were living off of just their Social Security income. And they were both good workers. They both have high income when they were working, so their Social Security benefits are pretty rich. As a household, their combined Social Security is like $88,000.
Okay, wow.
And that's all they need to fund their lifestyle.
Right.
For one primary purpose. Their income tax liability on $88,000 of Social Security is zero. And I think that surprises a lot of people that, well, your income is $88,000. Well, when you factor in the taxable portion of Social Security, you factor in the standard deduction, their tax liability today was zero. And that was something we were excited about for them.
Oh, for sure.
Applauded.
Right.
But at the same time, we had to tell George and Ann, that's great, but you're actually making a mistake. And the mistake was they're setting on all this pre-tax money today. And when they get to 73, as we mentioned earlier on the show, they're going to have a forced distribution, required minimum distribution from those pre-taxed accounts. And when that happens at the age of 73, it takes them from $0 tax liability, the zero tax bracket, all the way up to the 25% tax bracket when you factor in the Tax Cuts and Job Act, which is set to expire in 2025.
Right.
That is a whole show in itself.
Yeah, it is, yes.
So they're setting at zero tax today, but they project to be in 25% when they turn 73. Right. So we have these years, the early retirement years, that we can start moving pre-tax dollars to tax-free dollars strategically.
Right.
And what I would
do
say,
it when taxes are on sale.
They're on sale
right now, right?
Yeah, for them, on sale would mean anything less than 25%. So we want to take full advantage of 10% and 12% tax brackets for them while we can.
Yes.
And so we're implementing that strategy, and over the course of their lifetime, that is going to save them thousands of dollars in taxes at the same time giving them greater control of their financial future because that tax liability has already been paid at the rate that they were comfortable with.
Well, no doubt after hearing that story, folks are going to want to get their own complimentary tax report from you and the team to see, okay, how does this apply to me, right?
Yeah, that's what the tax report is all about, right? We were able to show them current tax liability to future tax liability with some level of certainty to that. Now, we don't know what the future tax rules will be, but we know what their projected RMDs are going to be when they get to 73. We know what their Social Security is. So we can do these comparisons for them with a high level of accuracy. And it tells us, hey, there's things we should be doing today to take advantage of this tax discount that you have available.
Absolutely. Well, Kevin, such wise words and such important information to know. And so if you're sitting at home and you're going, you know what, I want to know what my tax liability is going to be. I want to figure out how I can take advantage of the tax code right now to maybe you're in that same situation and you need to move some tax deferred dollars into tax-free money. We encourage you, pick up the phone, call that number 866-630-1675 or scan that QR code in the bottom right-hand corner to get connected with Kevin and the team from Citizen Advisory Group to get your complimentary tax report. More on the phases of retirement and financial planning right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back. You're watching Retire Well with Kevin Bucher, co-founder and financial advisor at Citizen Advisory Group. I'm your host, Kristen Oakley. And gosh, Kevin, we've been talking today about the phases of retirement planning, and there's so much that we didn't even get to talk about the early retirement years, but let's talk now about the late retirement years and what folks need to really be aware of during that period of time.
Yes, so we can't possibly get to it all, unfortunately. But again, what we're referring to as the later retirement years are once those required minimum distributions have kicked in. And there's still, everything we've talked about up to this point still applies. We still want to be able to look at our current tax liability, compare it to the future tax liability, and make sure that we're making the most informed decisions for ourselves. There's a couple planning opportunities that open up. The first of which is what is referred to as the qualified charitable distribution.
The QCD, right? Another
QCD.
Acronym to throw in there.
Yes. So it's a great tool that can be used to minimize your tax liability. For those of you that are giving to a charity, once you're 70 and a half, there's probably a more efficient way to do it from a tax standpoint. It allows you to get the full standard deduction while still being able to reduce your income by that charitable contribution that you're giving. So you do have to be 70 and a half. It especially comes into play once you're 73 and you have those forced distributions.
Right.
So it's a really efficient way to take the distribution and still give to the charity.
Right, you just transition it directly to the charity. They get the full amount and you get your tax liability lowered. It's a win-win for both parties.
Yes. So it doesn't mean that you have to all of a sudden become more charitable in your giving, but if you're doing it, you want to do it in the most efficient tax way possible.
Absolutely.
So the other thing I wanted to highlight in the later years, we're going to kind of lump together a few things, is for couples, and what is the tax impact going to be when the first spouse passes away?
Yes.
And we actually call that the widow's tax, and it's an unfortunate reality that for many, when the first of you passes, there's going to be a reduction to your income because you don't have 2 mouths to feed anymore. You don't have 2 insurance bills to pay. So there usually is a reduction in the income, but oftentimes we find that your income tax liability goes up. It's a lower income, but you're paying more in taxes. And that's just something we want to be able to evaluate ahead of time and see if we can reduce some of that tax bomb before you actually get into that survivor situation. But that also leads into an example that I want to kind of walk through. We didn't get a chance to get into too much about the non-retirement accounts that you might have accumulated.
Right.
Those are the accounts that you might have to pay some capital gains on your appreciation. In a pre-taxed account, your distribution is fully taxable.
Right.
In a non-qualified or individual or joint brokerage account, you really don't have to worry about paying tax on your dividend and interest growth and any capital gain that you might have. And sometimes we see as folks get closer to the end of life, where they start to make maybe some mistakes with those capital gains. Because what happens when the first of you passes, or when you pass if you're holding those capital gains, is the tax code today allows for what's called a step up in basis. And those gains get washed away and there's no tax liability. But if I sell those investments today, I have to pay tax on the gain.
Yes.
Similarly, if I gift those assets to Kristen, that's going to trigger the tax, and we're going to have to pay tax on those gains.
Yep.
So it's in particularly important for couples that have accounts that they have these capital gains in. So this is an interesting example. It's a little tricky to navigate from a landscape standpoint, but so Fritz and Patricia are a good example of this. Married couple, they're setting on large gains in their account.
Okay.
And those are taxable gains to them. Unfortunately, Patricia was recently diagnosed with a bad health diagnosis, and her outlook doesn't look very favorable. So it looks like she's going to pass prior to her husband, Fritz. And it's a joint account that they're setting on. And instead of just sitting back and doing nothing, if we transfer those dollars into Patricia's name only, if she were to pass first, Fritz will receive a full step up in basis on that account, and all the taxes get washed out. And then that will happen again when Fritz passes. If so, any appreciation from that point forward, we can get a double step up in basis. So my point of that is we just have to be really careful with gifting strategies at the end of life to make sure that we're doing it in the right way.
Well, and as you said, we didn't even get to the survivor legacy planning, but that's such an important thing. It goes into this overall financial plan, right?
Yes, it all ties together.
It does, absolutely. Well, Kevin, thank you so much for being here. To our viewers at home, thank you for watching. That number to call to get started on your own complimentary tax report, 866-630-1675. We appreciate you watching. We look forward to being back with you next time.